Most traders enter the market before the market has spoken. They feel something, they imagine something, they convince themselves that a move should happen, and in that moment, they are no longer trading the market. They are trading their need to be right. Price does not care about what should happen. It only reflects what is happening. Until price confirms, everything else is noise disguised as intelligence. Waiting for confirmation feels uncomfortable. It feels like missing out. It feels like watching others move while you stand still. The mind starts whispering that you are late, that opportunity is slipping away, that hesitation is weakness. But hesitation is only weakness when it comes from fear, when it comes from discipline. It is strength. Price confirmation is the market's permission. Without it, you are trespassing. Many traders mistake early entry for skill. They want the best price, the exact bottom, the perfect top. What they really want is validation. They want to feel smarter than the market. And the market punishes that arrogance quietly, slowly, and then all at once. When price confirms, doubt disappears. You are no longer guessing, you are responding. There is a calm that comes with that moment, a stillness. The trade is no longer about excitement. It becomes procedural, mechanical, clean. Before confirmation, emotions dominate. After confirmation, rules dominate. The hardest part is doing nothing while the setup forms. Watching price move close, then pull back. Seeing near misses. Feeling impatience rise, the hands want to click, the mind wants certainty. But certainty only exists after the market reveals its intention. Price confirmation is not about being late. It is about being aligned. There will be times when price moves without you. Those losses hurt the ego more than the account. But missed trades are cheaper than bad trades. Always. Entering before confirmation creates immediate stress. You watch every tick, every fluctuation feels threatening. You are fragile because you entered without permission. When price confirms, you are grounded. Pullbacks feel normal. Volatility feels expected. Confidence is not built from prediction. It is built from repetition, of discipline. Price confirmation also protects you from stories, news, opinions, analysis. All of them collapse when price disagrees. The market never argues, it simply moves. And the trader who waits for confirmation listens instead of talking. There is humility in waiting. You accept that you do not know what will happen next. You allow the market to lead. That humility keeps you solvent. The moment you commit capital, you commit emotion. That commitment must be earned by the market, not forced by the trader. Price always tells the truth, but it only speaks clearly after it moves. And the trader who learns to wait for that moment, stops chasing the market, and starts walking beside its first loss, is rarely the one that destroys a trader. It is the second decision after the loss begins. The moment when price moves against you and the mind starts negotiating, just a little more room, just a little more time, and in that space, discipline collapses. A loss accepted quickly is controlled. A loss delayed becomes personal. Cutting a loss feels like admitting failure. The ego resists it. The heart tightens. You feel exposed, foolish, smaller than you imagined yourself to be. But the market is not judging you. Only you are. The trader who hesitates at the stop has already broken trust with himself. There is a strange pain in closing a losing trade. It stings sharply, then fades. Holding onto it feels softer at first, almost comforting, but it grows heavier with every tick. The weight becomes unbearable. The account bleeds slowly. Confidence leaks. Quietly. Hesitation is hope, wearing discipline's mask. The market gives warnings before punishment. Momentum slows, structure weakens, price hesitates. These are not invitations to pray. They are instructions to leave. Ignoring them is not bravery. It is denial. Cutting losses without hesitation is not about being cold. It is about being honest. Honest about being wrong. Honest about uncertainty. Honest about risk. A trader who respects losses sleeps better. Not because losing feels good, but because chaos is contained. The damage is defined. The mind is free to reset. Every great survivor in the market learned this through pain. They did not learn it from books. They learned it from accounts that almost died. From positions that should have been closed earlier. From moments when pride cost more than money. The market does not reward stubbornness. It exploits it. There is relief in obedience. The click that closes the loss brings clarity. The fog lifts. The next trade becomes possible. Without that closure, everything that follows is distorted by fear. Losses are not shameful. Disobedience is. The trader who cuts quickly stays flexible. Capital stays alive. Opportunity remains accessible. The trader who holds loses more than money. He loses objectivity. Every time you hesitate, the market takes note. It pushes harder. It tests resolve. And if there is weakness, it exposes it. Cutting a loss is not an end. It is a reset. A return to neutrality. A chance to engage the market again without baggage. There is strength in walking away early. It takes more courage than holding on. The stop exists to protect you from the version of yourself that believes hope is a strategy, and the trader who learns to act without hesitation learns to survive before he learns to win. Winning trades test a trader more than losing ones. Losses demand humility, but winners demand restraint. The M.O. Meant profit appears, fear quietly enters. Not fear of losing money, but fear of losing what has already been gained. Most traders feel relief when a position turns green. That relief quickly turns into anxiety. Every pullback feels like a threat. Every pause feels like a reversal. The urge to protect replaces the discipline to allow. Letting winners run feels reckless to the untrained mind. The market never moves in a straight line. Progress is uneven. Advances breathe. Pullbacks are natural. But the trader who has not learned patience mistakes normal behavior for danger. Closing a winner too early feels safe. It feels responsible. It feels smart. But safety in trading often hides fear. The fear of giving back profits. The fear of being wrong after being right. Big profits are not built from perfect timing. They are built from imperfect patience. The trader who interferes with a winning trade is usually responding to emotion, not information. Nothing has changed in the market. Only the trader's comfort has changed. It takes discipline to sit still while money fluctuates. The mind wants certainty. The market offers probability. The gap between them is where most traders fail. Letting a winner run is an act of trust, not blind trust, but trust in preparation, structure, and behavior. Trust that the reason for entering still exists. Small wins feel good. They feed the ego, but they starve the account. One strong trend can pay for dozens of small losses, but only if it is allowed to live. The market does not reward nervous management. It rewards alignment. Every time a trader exits a winner early, he reinforces fear. He teaches himself that comfort is more important than opportunity. There is discomfort in watching open profit shrink temporarily. It feels like something is being taken away. But unrealized profit was never owned. It was only potential. Trader who understands this stops panicking at pullbacks. He watches behavior instead of balance. He stays as long as the market stays. Letting winners run requires silence, no overthinking, no constant checking, no emotional bargaining, just observation. Most fortunes in trading come from a few exceptional moves, not from constant activity, not from endless precision, from patience during strength. The hardest part is not entering, it is staying when others exit, staying when doubt creeps in, staying when fear suggests locking it in. The trader who learns to let winners run learns to accept temporary discomfort in exchange for lasting growth. And that lesson changes everything about how the market is experienced. Patience is not passive. It is active restraint. It is the decision to wait while every instinct demands action. In trading, this restraint becomes an edge because so few possess it. The market offers endless opportunities, but not all at once. Most of the time, it offers nothing. Silence, random movement, confusion. And in that silence, traders reveal themselves. Impatience disguises itself as ambition. It tells you that you are wasting time, that you should be doing something, that activity equals progress. The market punishes this belief without mercy. Waiting feels like falling behind. Watching others trade makes the stillness feel heavier. The fear of missing out creeps in. The mind starts creating setups that do not exist. Patience protects you from manufactured opportunities. A trader without patience trades boredom. He trades frustration. He trades the need to feel involved. And these trades rarely align with structure or confirmation. Real patience is uncomfortable. It requires emotional control when there is nothing to control. It requires faith in process when there is no reward in sight. The edge of patience shows itself over time. It reduces losses that never needed to exist. It preserves capital for moments that matter. The patient trader understands that the market is a rhythm, not a machine. There are moments of expansion and moments of rest. Acting during rest creates noise. Acting during expansion creates opportunity. Impatience compresses time. It forces decisions too early. It creates stress where none is required. The trader begins to chase rather than observe. Patience allows the market to come to you. There is clarity in waiting. When you stop forcing trades, setups become obvious. Price behavior stands out. Noise fades. The patient trader feels less emotional because he is not constantly exposed. Fewer trades mean fewer decisions. Fewer decisions mean less room for error. This edge cannot be measured on a chart. It shows up in equity curves that survive drawdowns, in accounts that last, in traders who remain calm during chaos. Most people do not lose because they lack intelligence. They lose because they lack patience. Patience also changes how losses are experienced. When you wait for high-quality setups, a loss feels acceptable. It was earned. It followed rules. It does not shake confidence. Without patience, every loss feels personal. It feels unfair. It feels random. The market does not rush. It moves when conditions align. The trader who matches this pace finds harmony. The trader who fights it finds exhaustion. Patience is built slowly, through missed trades, through watching, through resisting impulses, through learning that nothing breaks when you do nothing. In a world addicted to speed, patience becomes rare, and rarity is what creates an edge. Ego enters trading quietly. It does not announce itself. It hides behind confidence, conviction, and experience. It whispers that you know better, that this time is different, that the market will eventually see what you see. The market does not negotiate. Ego. It exposes it. Ego wants to be right. Discipline wants to be consistent. These two cannot coexist for long. When ego leads, rules bend. When rules bend, risk grows unnoticed. A trader driven by ego takes losses personally. He feels attacked by price. He looks for someone to blame. The market becomes an opponent instead of a system. Ego hates being wrong more than it loves being profitable. It shows itself when stops are moved, when losses are justified, when rules are broken after a few wins. Success feeds it faster than failure. After a winning streak, ego grows louder. It suggests increasing size, skipping confirmation, trusting instinct over process. And, when the inevitable loss comes, it comes heavy. Ego also shows up in revenge trading. The need to recover immediately, the refusal to accept a loss as part of the game. This urgency blinds judgment. The market preys on urgency. True confidence is quiet. It does not rush. It does not prove. It follows structure. Ego demands recognition. It wants the market to validate intelligence. Every trader has felt the moment when pride delayed an exit, when hope replaced logic, when a small loss became something much larger. Ego turns temporary pain into lasting damage. Letting go of ego feels like surrender. It feels like giving up control. But control in trading is an illusion. The only real control is over risk and behavior. The trader who learns to step aside emotionally sees more clearly. He reacts less. He listens more. Ego filters information selectively. It notices what confirms belief and ignores what contradicts it. Price changes, but ego stays committed to the old narrative. The market punishes narratives. Humility is not weakness. It is flexibility, the ability to change when conditions change, to exit without explanation, to re-enter without resentment. Ego holds grudges. Discipline resets, the most danger. As moment for a trader is feeling invincible. That feeling invites carelessness, and carelessness invites loss. Every rule exists to protect the trader from ego, stops, position sizing, waiting, exits. They are safeguards against emotional blindness. The trader who survives long enough learns that the market does not reward brilliance. It rewards restraint. When ego fades, decisions become lighter. Losses become manageable. Wins become quieter. The market becomes clearer when the need to be right disappears. Survival is the first victory the market demands. Before profit, before confidence, before ambition, the trader must learn how to stay alive. Most never do. They aim for growth before stability, and the market removes them quietly. Profits come and go. Survival stays. The market is not generous to those who rush. It tests endurance before it rewards skill. Accounts that cannot survive drawdowns never get the chance to compound. Every trade risks survival, not just capital. One careless decision can erase months of discipline. One oversized position can end a career before it begins. The trader who understands survival trades smaller than his confidence suggests. He protects downside obsessively. He knows that opportunity repeats, but capital does not regenerate easily. Survival requires restraint. Passing on trades that look good, but not perfect. Reducing size when conditions are unclear. Stepping away when emotions rise. This feels limiting at first, like holding back potential. But restraint is what keeps the trader in the game long enough to realize that patience multiplies opportunity. Many traders chase profits aggressively, believing speed creates success. They ignore risk until it demands attention, and when it does, it arrives without mercy. The market does not warn before destruction. It simply accelerates. Survival also means emotional preservation. Prota. Seating confidence. Protecting clarity. Avoiding the spiral that follows heavy losses. Once the mind breaks, the account follows. A trader who prioritizes survival accepts slow progress. He understands that consistency outperforms bursts of brilliance. That steady participation beats dramatic exposure. Every great run in the market starts with durability. Withstanding losses without damage. Staying calm when others panic. Remaining solvent while others disappear. Survival teaches humility. It forces realistic expectations. It replaces fantasy with process. The trader who survives learns patterns not visible to the impatient. He recognizes when the market shifts character, when risk increases, when aggression must decrease. Survival creates perspective. It teaches that missing a trade is irrelevant compared to missing the future. When survival becomes the priority, pressure fades. Decisions become cleaner. Trades become deliberate. The trader stops trying to conquer the market and starts cooperating with it. Profits come as a byproduct of longevity, not as a goal chased recklessly. The market eventually rewards those who respect its power long enough to endure it.